Well, the Fed staying the course in its aggressive fight against inflation with another rate hike. The move set to further dampen markets and make mortgages and other loans less attractive. For a look at how this is going to affect your personal investments, let's turn to Katharine George, Wealthstream Advisors Senior Advisor. All right, Katharine, take us into your reaction yesterday after the commentary from Fed Chair Jay Powell, the decision from the FOMC, and how the markets are digesting this as well.
I mean, we've been seeing this for a while, right? They've let us know that this rate hike was coming, and the market priced that in a while ago. Maybe there's some short-term noise here, but we were expecting this. Maybe we weren't expecting to hear that in 2023 there could be additional rate rises, which is why the market is probably reacting the way that it is. But we've been through this economic cycle before. It's not that unexpected, and the stock market, the bond market will all come back. And it's actually a great thing for the bond market. But, happy to go into stocks, bonds, whatever you're most curious about.
Well, let's talk about the bond market. Let's linger on the bond market, if you will, a little bit. It hasn't been a great time for the bond market thus far this year, right? And you've got both stocks and bonds that have been losing on the year, which is an unusual occurrence. As you said, we've seen this environment before. That particular piece of it is not so common. So how do you navigate through that for your clients?
You're right. And, in the bond market, it's a little bit different in the stock market in that the price today doesn't matter all that much as long as you stay invested. The bonds we bought last year become less valuable because a new bond will pay you a higher coupon rate. But as long as you hold on to that bond that we bought last year, you're still going to get the same coupon payment that they promised you, and you're still going to get your principal back at maturity. So, that's the one thing. But once those bonds start to mature, you're actually going to be able to buy much more attractive bonds at higher rates. And it's going to be, much healthier for your overall portfolio, especially for those investors that have a decent portion of bonds. Let's say you're headed towards retirement or you're in retirement. You're actually going to start to be able to earn a decent return on that portion of the portfolio. Whereas, the past 10 years, we haven't seen that. So it's actually a good future outlook for the bond market. It's just a waiting game.
Katharine, as we're seeing today, the market does not like when the Fed comes out here and suggests that rate hikes are going to continue for the foreseeable future. Having said that, is there anywhere an investor can hide out in this volatile environment?
Hiding out is it's a tricky thing. So the first thing I'd say is don't overreact, right? Stay invested, keep your stocks and bonds where they are, and don't overreact. But I think the biggest thing is the cash, right? We're finally able to earn some return on our cash. If you're uncomfortable with putting any of your extra cash in the market right now, then make sure you're getting some sort of a return on that. Online bank accounts are offering about 3% right now just to sit in cash. And treasury bills, you can get a 6-month treasury bill for 4.5% right now. That's a very liquid, market. 4.5% is great. So that's one option. But really, if you're feeling like you can take a little bit of risk right now and you have extra cash on top of your emergency reserve, and maybe a little bit extra if you have a job that you're worried about in a pending recession. But if you have some extra cash, stocks are on sale. It's actually a really good time to put some long-term money away as long as you can stomach kind of the ups and downs of the market.
Even with today's move lower, we're not sitting at the lows in terms of this larger kind of downtrend that we've seen for the major averages and the markets more broadly here. Do you believe that a recession has been priced in, at least at the bottom end of where we've kind of seen the activity take place over the past few months?
Yeah, so I can tell you that I think everyone is expecting a recession, and that's likely priced in. Are we at the bottom? I have no idea. But if we look back to 2008, 2009, by the time the recession was actually announced, the stock market was already on the way back up. So, recessions are backward looking. And as we all know, stock markets are forward looking. So while they're related, if the recession comes out in 3 months, that doesn't mean our portfolios are going to drop another 20%. Everyone is already thinking about this. It's been in the news for the past year. So yeah, I think it's already priced in. We just don't know if it's going to drop a little bit more in the meantime.
Katharine George, Wealthstream Advisors, Senior Advisor. Good to see you again. We'll talk to you soon.